Thank you, everyone. I appreciate the opportunity of just being here. So it really is a pleasure to be here. I am licensed in Pennsylvania, New Jersey, New York. I've been practicing 20 years now. And my specialty is I do some litigation work, but also estate planning and trusts. I have a second law degree, which is a higher degree than your normal Juris Doctorate degree, which every lawyer has. It's a specialty in taxation and estate planning. So I'm one step ahead of most lawyers who don't have that degree, because it's 2 more years of law school to get the second degree, which I think is less than 1% of lawyers have it. So one of the things I have clients that ask me all the time are, how do I protect my assets from creditors or from inheritance tax? If you own property in Pennsylvania, if you pass away, your children, if they were going to inherit, would pay 4.5% inheritance tax. That's across the whole state of Pennsylvania. Each state is unique and different in its own. So, for example, people move to Florida because Florida has 0 state tax. So, if you have investments in Pennsylvania, the only way you can protect against it from being taxed on an inheritance point of view is to shelter it in an irrevocable trust. So I will explain to you the 2 types of trusts, the main topic of trust, and that's revocable versus irrevocable. But I'll also explain if you just had a will. What would a will do? Because some people call me and they'll say, I just want a will. And I said, okay, what do you have? Well, I have 5 properties all paid off. Okay, well, you know your children are going to get inheritance tax at the end. They're like, oh, I didn't realize that. And then now they start thinking about the trust. Because when someone passes, if they want to leave everything to their children, they're going to be the ones who bear the cost. Unfortunately, most people don't have 4.5% of the equity in the property to pay upon death, so they end up selling the property to pay the taxes. So if you had, I'll give you an example. I had a client who called me, who was an investor. He had 14 properties in Fishtown. They're probably worth $6-7 million, all paid off. If he passed away, his children would pay 4.5% on $7 million. So that's $240,000. They would have to sell one of the properties just to pay the taxes, unless they had $240,000 in cash to pay it. And the tricky part when you file for probate when someone dies is you only have 9 months to file the tax return. So if you have to raise that tax money when someone dies to file the inheritance tax, you only have 9 months to come up with the tax burden. Or you pay a tax penalty, which is heavy. We don't want that for anyone. No one wants to pay taxes. And if you have to pay taxes, you don't want to pay it with a penalty. So if you did just the last will will dictate who you want to be the executor and who you want to inherit. So there's the 2 parts that are critical in a will. So we call the person who's in charge of your will your executor. They're the ones who make decisions for you. You tell them what you want, and they follow your wishes in a will. The beneficiaries are the ones who inherit in a will. So if you say everything goes to my children or to my wife or my children after I die, then that's the beneficiaries. The difference between a will and a trust is you don't own it when you die, the trust owns it. So you could say, I want everything's in the trust for my benefit as long as I'm alive. When I die, the trust puts the assets, gives the assets to the benefit of whoever your beneficiaries are. That could be your children, your spouse, it could be your friends, relatives, whoever you want to wish it to. And the trust will survive for generations until it's closed out and terminated. So there are 2 types of trusts. One is a revocable trust. A revocable trust means you can still control it, and you still own it. The trust owns it, but it's for your benefit, and you're the controlling party. So when you create a trust, there's 3 characters to every story, right? In this one, the character is the person who's creating the trust. We call that the grantor. The person who's the trustee, they're the one managing the trust. And then there's the beneficiary. That's the person who's benefiting from the trust. So with a revocable trust, you could be all 3. It's the only time you could be all 3. But because you could be all 3, you technically still own the property because it's just changing the title into the revocable trust name. So it gives you no protection. So you still have inheritance tax liabilities. You still have creditors could come after you and pierce the trust and come after you if you owe creditors money. If you get sued and there's a judgment against you, it can follow you into a trust. So I don't like revocable trusts. The only reason I would maybe even recommend it is if it's something you want to put in temporarily and you want to close it very quickly. So you want to give yourself some protection while you're alive and liquidate it immediately, you can do that with a revocable trust. The irrevocable trust, however, you can't be all three. You can only be two. So you're either, if you own the property, you're going to be the grantor. So you're the one putting the property. So then you have to make the decision. Do I want to be the beneficiary or do I want to be the trustee? So if it's for my children's benefit today, I'd be the trustee and my children benefit today. If it's for my children's benefit in the future, I'll be the beneficiary today and I have to name someone I trust to be the trustee. So that's the critical part where people get stuck, is they don't trust anyone. So it's tricky. That's why the title is called the trustee. You have to have somebody you could trust to be your trustee. So normally you'll have somebody that's, let's say, married, and one spouse is the trustee for the other and the other is the trustee for the other, and they keep two trusts separate. You know, some properties in the husband's name, some in the wife's name, and they just kind of, you know, one's the trustee for the other's properties. The other way you could do it is you could have another family member or friend that you trust with your life. The trust will say exactly what your wishes are. So I want my rental income to come to me for as long as I'm alive. If you violate this, I will remove you. And you could put that in the trust. So while a trustee has power, they still have revocable, they can lose their power. So they can be stripped of that power if they violate it. So while some people hesitate about the trustee portion, there is some protection for the grantor. So that's really where the ultimate benefits of it go. So it protects against irrevocable trust. It protects against inheritance tax and protects against creditors. So if you get sued or you didn't pay your credit card bill, they come after you, that's protected asset, as long as it's not in the name of the trust. So if you took a loan in the name of the trust, they're going to come after it. And also, it voids probate entirely. So when someone dies, you don't have to file any inheritance tax. You have to go through the probate. It just stays in the ownership of the trust. The beneficiary just gets substituted out. So if I die and I have a trust for myself as a beneficiary, it just goes to my heirs. So whoever I named as the beneficiaries. You could also name it in portions too. You don't have to give everything to one person. You could say, I want my 3 brothers to inherit equally or something like that. The downside of a trust. So irrevocable trust has a couple downsides, but it's determined on how you look at it. It's a negative if you want it to be a negative. So the negative would be that once you create a trust, it's very difficult to close the trust. So you want this to last a very long time. You're not going to do it for 3 months and close it. So how do you keep that going on forever? So if you want to sell a property, it's in the trust, you could do a 1031 exchange. So some real estate people are nodding their heads. They know what a 1031 exchange is. So as long as you buy another property of similar nature, like residential for residential or commercial for commercial, of greater value than the sale price. So if you sold it for $300, buy something for $310. You know, just buy just a little bit more, and you're qualified for the 1031 exchange. You can't do it for less because then you'll pay capital gains. If you live in the property, you could maybe have some exemptions on the homestead exemption for capital gains. So you may not use it. The other downside is there is a tax return filing. Now the tax return filing is very similar to an LLC. It's a 1041, I forget the letter, there's a letter afterwards, like 1041R or something like that. It's similar to a Schedule C and a LLC, where you have to do a return for just the trust. So it shows what's the income, what's the expenses, and then what's the net proceeds to the beneficiary. And then it tells you what line to put it in your 1040. So let's say the trust paid the beneficiary $50,000 in income this year, right? After all expenses are deducted, it goes to the beneficiary, $50,000. That person would get a 1099 from their own trust, and they report that as income on their own tax return. If you're doing rental income, you're going to be paying taxes on the rental income anyway, so it's really no downside to it. It's just a different tax form. Instead of a Schedule C, you're doing a trust document instead. So again, some people get scared when they hear a tax form. It's about the same number of pages as a Schedule C. So if you have a good accountant, they'll do it for you. Just give them the income and expenses. If you have assets that are not income driven, it's great because all you do is 0000, file the return, and you're done. So for example, if I put my house that I live in, I don't rent out, it'll be a 0 asset trust. So I'm not paying taxes on it. If I'm renting it out, then I would pay taxes on it if there's a profit at the end of the year. So Other things you could put in a trust besides real estate. I know we love real estate. That's our biggest way to gain profit and wealth in the world. You could put in their bank accounts. You could create a trust account. Now, what you do is you put your capital in it, which is whatever money you want to invest in your own trust. And let's say you just leave that as your spending budget, right? And you want to draw from it. You could do that. But you could also invest that money, and that money will gain money on its own in the trust. Let's say you did investments or something like that within the trust. You could have an investment account owned by a trust. So you could buy and trade stocks, Bitcoin, whatever. And at the end of the year, you just file the same tax return. Nothing's more difficult than that tax return. It's not very difficult at all. And so if you get a very good yield and you get high dividends and you're making a profit and you're selling things, you're going to pay a tax return no matter what you do. You just do it through the trust. But if you have, let's say, a life insurance policy, you could name your trust as your beneficiary. So when you die, your heirs will get that money. Now here's the difference. If you just had a will, you don't name your beneficiaries in a life insurance in a will. So if your kids are 19 or 20 years old and they inherited $1 million life insurance policy, they're probably going to spend it very quickly. If you have it go into a trust, the trust will control it and the trustee will dictate how that money's going to be spent. So you could have somebody managing it for the children. So if the children are going to get $1 million and they're 21 and 23, for example, you don't want them blowing that on, Ferraris and, trips to, Aruba. You want it to be managed within the trust so it's invested and lasts a lot longer. It's how you create a legacy. So most people associate when they hear trust fund babies, there are many generations. They last sometimes 4, 5, 6 generations. The Vanderbilts and the Gerards, they all have had trusts for 200-300 years. That's because they invested that money, they bought real estate, they put the money in stocks and bonds, and sometimes life insurance policies, and that money just kept growing and growing and growing. And while the beneficiary still took money from it, it was not enough to deplete it. It kept growing more and more. So that's the way you create a legacy. If you want to learn more about that, what I would suggest is I could do a one-on-one with you guys. You have the card. You can always email me. I'm happy to sit around afterwards as well and speak to people. Obviously, I don't want to talk confidential information, but we can talk generally because I don't want anybody's confidential information out there. But we can talk generally. We can set up an appointment, and I'm happy to go through your profile individually and tell you if a trust is right for you and how we would set it up and what estimated costs would be, who you want as a trustee. We'll talk about all the questions you're going to have about it. But this is just an initial conversation to kind of grow your mind, understand what it is, because a lot of people have this misconception that's very complicated, very difficult. If you have a good attorney and a good accountant, those are the 2 elements. If you have somebody who can do your taxes for you, you're great. If you know how to do your taxes, even better. Those are the 2 elements you really need to complete a trust to a T. The third element is having a trustee you trust, if it's for your own benefit. So if it's not for your own benefit and you're the trustee, then it's even better. You can put something for your children and you control it for their well-being.